When you walk into a supermarket, it is estimated that over 75% of the products on the shelves actually come from just 10 companies. It might seem like an endless sea of brands, but if you follow the money up high enough, then there are just 10 major companies that produce the majority of these brands. Unilever may not be the largest within the 10 companies, but they most certainly are the most diverse. You can wake up, shower and bathe, brush your teeth, have your meals and clean the house, all using products which are made by Unilever. It is estimated that 7 out of 10 households globally use at least one of Unilever's products each day. The consumer goods markets has continued to be competitive over the last few years, yet Unilever has continued to grow its dividend since 1999. In this video, I'm going to do a comprehensive stock review of Unilever and explain whether it deserves a spot in your dividend stock portfolio. Welcome to The Nimble Nomad. My name is Arjun, and this is the channel where I talk about money and investing related tips, tricks, and hacks. I would really appreciate if you can give this video a like and subscribe to my channel. You should never invest in a business that you don't understand. So today I'm going to explain the business and stock history of Unilever. Unilever has a long and complex history dating all the way back to 1872. However, the history of Unilever is imbibed in one common ingredient, which is fat. In 1872, two Dutch brothers began to produce margarine, which later, through a series of investments, went on to become Margarine Uni. Simultaneously, on the other side of the English Channel, Lever Brothers started producing a household soap called Sunlight. In 1929, the unification of Margarine Uni and Lever Brothers resulted in the creation of Unilever. The company until 2020 has operated as a joint venture with two separate headquarters, one based in the Netherlands and the other in the UK. In 2020, under the guidance of the new CEO, Alan Jope, the company decided to unify and restructure into a single entity to accelerate growth whilst continuing to list on the London, Netherlands, and New York Stock Exchange. So what does Unilever's business look like today? Unilever PLC is one of the oldest and largest companies. It operates in the fast-moving consumer goods industry worldwide. Its business can be divided into three main segments: beauty and personal care, foods and refreshment, and home care. The beauty and personal care segment offers skin care and hair care products, deodorants and skin cleansing products under the brand names Axe, Clear, Dove, Lifebuoy, Lux, Pond's, Rexona, Signal, and Vaseline brands. The food and refreshment segment offers soups and bouillons, seasonings and sauces, mayonnaise, ketchup, ice cream, and tea categories. This segment offers its products under the Ben & Jerry's, Hart, Hellmann's, Knorr, Lipton, and Magnum brands. The home care segment offers various fabric solutions, home care products, and hygiene products under the brands Cif, Persil, Domestos, and Sunlight. Unilever owns more than 400 brands, including $11 billion brands, which each achieve annual sales in excess of 1 billion euros. In more recent years, Unilever has sought to acquire niche brands within the consumer goods space that appeal to millennials and those that are marketed as independent brands, such as the British tea brand called Pukka Herbs and the Dollar Shave Club, which is a US-based men's care brand, to allow Unilever to tap into the subscription model and direct-to-consumer supply chain. Whilst these new brands do not significantly increase Unilever's overall revenue, they allow Unilever to grow at a faster pace, which we will explore later in the video. As a whole, Unilever has many competitive advantages which allow Unilever to retain market share and ensure profits. They have powerful brands such as Axe, Dove, Ben & Jerry's, Hellmann's Mayonnaise, Knorr, Domestos, Persil, and even the newer millennial brands like Pukka Herbs and Dollar Shave Club. This promotes consumer loyalty, which is really important to growing and retaining market share within the consumer goods segment. Virtually all of their products are high margin, which allows Unilever to increase prices and reinvest profits in acquiring new brands for growth. Unilever has the ability to buy their way into new markets as the consumer goods market is increasingly getting more competitive. Unilever has strong brand and category leadership positions in the USA, India, and China, with around 35% of its turnover coming from those three countries alone as of FY20. And Unilever can bring sharper focus in those geographies and build even stronger positions. There is also significant opportunity beyond these markets, and Unilever can continue to build on its strong operating businesses in the world's fastest growing economies. The new CEO, Alan Jope, who took over the company, has been with the company since 1985, and prior to being appointed as CEO, he was the president of the Beauty and Skincare division. He has a strong track record of growing this business both within the developed and emerging markets. Jope has been credited with lifting the company's Chinese market sales by nearly 10% whilst he was posted in China. Having recently heard him speak, I'm quite impressed with his skills and vision to grow Unilever through acquiring niche brands and targeting millennials.
It is true, our multi-year range that we've given is 3 to 5% growth. At the moment, our markets are not growing that well, and so we guided this year to deliver between 3 and 4% growth, and that is the range that we've been delivering results in. Ultimately, stepping up our growth is about being relevant to consumers, and we know that as younger generations of consumers come through the population, businesses that conduct themselves responsibly and brands that offer choices to buy products that are sustainably sourced are more relevant, and people shift their purchasing behavior. And so in that way, by making sure that our portfolio is relevant to the younger groups of consumers coming into the economy, that will be part of our overall growth step up.
Despite Unilever's diversification and global reach, the company is not immune and is subject to several risks. The two major risks Unilever faces are sustainability and competitors in the consumer goods space. Unilever prides itself on its sustainability agenda and recognizes the importance of this for its customers. Unilever's vision is to double the size of its business whilst reducing its impact on the environment. However, over the recent years, Unilever has come under fire for its use of plastic packaging and the subsequent impact this has had on the environment. Further, Unilever's revenue and sales is highly dependent on product placement and gaining premium shelf space within supermarkets. Supermarkets are not only very tough negotiators, they often produce in-house brands which directly compete with Unilever's products. Brand loyalty and market positioning of Unilever's products will be key to ensuring that Unilever can continue to grow its revenue through sales and maintain profit margins. Okay. Now let's dive into the financial fundamentals of the business. 41% of Unilever's revenue comes from the beauty and care business, 36% from the food and refreshments, and 23% from the home care business. So Unilever is still very heavily reliant on its established high-value brands for majority of its revenue, despite efforts to diversify into niche, smaller, high-growth brands. Unilever's revenue has been static over the last few years between 50 to 53 billion euros. However, the gross operating profit, net profit, and the free cash flow have all been growing within the same period. In the most recent FY 2020 announcement, Unilever reported a 1.9% underlying sales growth and free cash flow of 7.7 billion euros. Up by 1.5 billion over the previous year. Unilever has consistently grown its free cash flow over the past 10 years, and its free cash flow growth over past 5 years was 13.10% per year. This ensures that dividend payments that Unilever makes to its shareholders will continue to grow as its free cash flow grows. Unilever maintained its dividend through 2020 and in Q4 raised its dividend by 4% to 42 cents per share. Whilst the company's overall revenue decreased by 2.4% in 2020, this was attributable to negative impact from currency exchange as the company reports its financial results in euros. I have a special bond with Unilever as both my father and I have worked for Unilever at some point during our careers. When I was a child, my dad would often get free products from Unilever as a part of the company's Christmas hampers, and we would pretty much use only Unilever products at home. Unilever is one of my top holdings within my stock portfolio, and I own 111 shares with a cost per share of £40.02 and an average dividend yield on cost of 3.7%. So totally, I have £4,442 invested in Unilever currently. Personally, I will continue to add to Unilever's stock as the stock price drops below my average buying price and it approaches a dividend yield of 4%. However, don't take my advice blindly, and you should always do your own research before making investment decisions. Thank you for watching this video. If this video helped you out, I would really appreciate if you can leave a like and subscribe to my channel, as I will be producing more similar stock analysis videos like this in the future.